All right, so today is Wednesday, November 8th, 2 p.m. section. This class is being recorded. First things first, here is the sign-in sheet. Make sure you sign the sign-in sheet before you leave today. And what we're going to mostly focus on in class today is I posted under Files, Lecture Notes, Lecture Note 4. We are going to be starting the fourth section of the class today, which is on multiples or comparable analysis, that content. So that's where we're going to spend most of our time. So while I give you a chance to download that PowerPoint and file and get it ready to go, I want to just talk about next Monday. Okay, so 1 week from today is the third group case presentation, 5 days from today, third group case presentation on valuation. All of you selected your companies on Monday. By Monday, 10 a.m., as a team, you're going to turn in 5 files, your 4 Excel files, plus you're going to turn in your PowerPoint. Okay? During the 10-minute presentation, you're going to cover essentially each of the 4 models, the key assumptions you're changing across the 4 models, and then you're going to finish with a buy, sell, hold recommendation of the company based on your target valuation. Okay. You also have to make sure you're referring to numbers throughout, and you have to use real-world data to support some of your assumptions as you go through that. So, any questions or challenges with your group projects before Monday that you want to address now? Is everybody good with the companies you've chosen? Final part, as we talked about at the end of class, you have to turn in companies that have balancing CFIs. All right, if you turn in invalid models, I'm going to give you a 0 out of 10 on your group project. So very important that your team, if you do have any unbalanced CFIs, fix that as part of your evaluation process. No issues with that. Remember, TAs have office hours the next 2 days if you want to take advantage of that. And other than that, looking forward to hearing what you guys have to say on Monday. We're going to learn a lot about this new industry. So, second point I just want to make is I got a bunch of emails about the Monday before Thanksgiving, right? And rather than responding to everybody whose basically sad song was, I want to leave town for such and such a reason, is this going to be an excused absence or we're going to have class, yada, yada, yada. Here's how I've decided to handle this. According to university policy, the Monday before Thanksgiving is a real day. We're supposed to have classes that day. The Wednesday before Thanksgiving, the university's made that a day off, okay? But Monday we're supposed to have class. All right, so here's how I'm going to handle it. Made an announcement about this. Option 1, if you don't want to show up for that day, you don't have to, and I won't count it as an unexcused absence, okay? So if you don't want to be here, I don't really want to be here anyways. If you don't want to be here, then just don't be here, and it won't hurt your grade, and it won't count against you to the final exam opt-out. We're not going to take attendance that day, okay? So then you can have the whole week off, do whatever the heck you want. Or, option 2, for the people that choose to show up, and I will be there, on Monday, October 20th, there will be an in-class extra credit activity using Bloomberg, okay? It's worth 2 points towards your semester grade, right? If you do the extra credit in class, you get 2 points towards the extra credit of points towards your semester grade, right? The only people that will be eligible for the extra credit are the ones that show up. If you don't show up to that class, don't care what your reason is, I don't let that extra credit be made up. So you have a choice. If you're interested in extra credit and you want the extra credit, I'll see you guys Monday, November 20th. If you don't really think you need the extra credit or don't care about the extra credit, you got a whole week off. It's your choice. It won't count against you otherwise. Questions about the choice and the options for that day. And again, you don't need to tell me whether you're showing up or not. I'll see the people who show up and we will do the extra credit. Right? And it will involve using Bloomberg, so you'll physically have to be here to do the extra credit. If you're not here, you won't be able to do the extra credit. Yes, sir? You'll have to turn it in. That's how I'll know that you did it, and we're here. So, all right, so let's talk about multiples. So as I said, we're going to go into the fourth section, also multiples, comparables, comparables. All right. And I do want to remind you of what's called the law of one price. No matter how we do valuations, whatever method we use, we still have to come up with the same answer. Like there's only one value to a company no matter what our approach is, right? So multiples as an alternative form of valuation still has to sync up with a DCF, right? So always remember that. But multiples are the shortcut. So just as basically ROIC is a proxy for free cash flow, multiples are the shortcut for free cash flow valuation. Okay? It's just easier to do than DCF. The other thing about multiples is they tend to work backwards. Meaning with a DCF, we predict the cash flows. We say based on these cash flows, we get to a value. With multiples, we start with the values in the real world, and then we try to better understand the cash flows that led to them, like what, and based on other things that look similar. Okay, so it's based on real prices as opposed to forecasts, but we still have to get to the same answer. So the key to a multiples analysis is we look for things that have similar prices, and by proxy say, based on that, we infer a value, right? So in the real world, for all of you, when you graduate, probably one of the first multiples you're going to run into is if you ever try to buy a house. Because when you buy that house, there's going to be an appraisal, okay? What the appraiser is going to do when you want to buy that house to come up with a value for that is they're going to look at all houses that have sold in the last 6 to 12 months that are similar to yours, and they're going to look at the sales price and then look at the square foot. So let's say houses sold at $400,000 and they had 2,000 square feet. Okay, so what they'll do is they'll take 400,000 divided by 2,000, and they'll say the average price per square foot was 200. Okay, and let's just say that that's the average across the area, $200 per square foot. And your house has 2,200 square feet. They'll take 2,200 times the 200 per square foot average, and that'll be the starting price for your appraisal. Okay, and then they'll adjust it up or down based on other factors. Right? So for example, how old is the house? How big is the lot? Okay, how many bedrooms does it have? Because maybe yours has an extra bedroom. You have 5 bedrooms, and all the other 2,000 square foot house only had 3 to 4 bedrooms. So for the extra bedroom, that might be worth more. All right, what's the school district you're in? Maybe you're in a better school system than some of the others, and people pay more for that. You know, maybe you're on a busy intersection, and other houses were in cul-de-sacs. There might be some adjustments for that. Okay, age, condition, etc. But the point is, there'll be some adjustments, but the starting point is that price per square foot based on similar things. Well, the same is true for companies, right? What we're going to do is we're going to look at similar companies, what their people are paying for them based on real world prices, and then we'll make some adjustments up or down based on growth, based on ROIC, you know, just based on performance. But nonetheless, it gives us starting points to price things, right? So one of the things is that multiples then become useful not only to value public companies, but to value private companies. Because I can take somebody who's private and say, look, if you were public, because you kind of look like these companies, this is what you probably are likely worth, right? Or if you ever work in mergers and acquisitions, like say you get a job in investment banking, it's what we use for acquisitions. They're called precedent transactions. I want to buy a company. What have people paid for previous acquisitions to get a sense of what's a fair price for an acquisition, okay? So lots of different ways to use multiples, right? Banks like multiples because they're defensible, right? Let's say that you're hauled into court to defend real estate pricing in front of a judge, okay, or a jury, right? Here's the point. If you do a DCF, and I'm not going to talk about the jury trial that's happening today nationally, because that's just, those multiples are indefensible. But that's the point. That's why they're indefensible, because there's multiples for what things are paid, and when you say that things are worth a lot more than what other things are worth, then that's called fraud. Right? You can't do it that way, because that's the point. That's the whole idea of multiples. But back to this, the whole point about multiples is if you are sitting in that jury and you have to defend Goldman Sachs because you were sued for the acquisition price that didn't go well, you can say, I based it on those prices, right? Versus I based it on a DCF and these assumptions. It's just easier to use the multiples. So the answer is you do both. You'll triangulate. You'll use multiples and a DCF when you do your valuations. Back to this. So the problem with multiples is you need similar companies, right? Because if I'm going to compare you to something similar, I need something that's similar. And that's actually more difficult than you think it is. For example, let's say you're comparing Disney and Netflix. On the surface, seems a very reasonable comparison because they're compared all the time. But if you think about it, what's the problem with comparing Disney with Netflix? Are they really comparable? What are some of the challenges? It's like shaking your head.
Well, Disney has so many more like industries they're part of. For example, this is just
So what are some of Disney's other industries?
like theme parks.
They got the theme parks. They got cruise lines. right? So they're not just Disney Plus, they're not just a studio. And so that's the problem. Like when you compare Netflix, Netflix doesn't have theme parks, not yet. Netflix doesn't have physical retail stores. Disney's got stores, Disney's got cruise lines. You call them comparable, but it's not really an apple and an apple. But it's what we do, all right? But we've got to recognize that there's some limitations on that. The other thing is we compare companies at different stages. For example, some people will compare Facebook, called Meta, with Snapchat, okay? Snap and Meta are not really comparable. They're completely different stages of their life cycle, completely different size companies with different growth rates and different business models. So yeah, you could say they're both tech social media companies, but as I said, that's the problem with multiples. In the real world, finding true comparables, simple as it sounds, is not as easy as you think it is, and we often make compromises, and that creates some challenges with the multiples that we have, all right? And timing becomes an issue. For example, if we looked at acquisitions in 2023, they're going to be different prices than were paid in 2021 because interest rates have skyrocketed. Risk profiles are different. We're in a tougher inflationary environment. So as a result of that, the values would be different. So you can't compare across the couple of years because it's harder to compare. The environment was different. So we just got to be careful about that when we do multiples. But nonetheless, they're simple. The steps are pretty straightforward. Step one is actually the hardest step, which is find true peer companies. Okay, that's the first step. Number two, get the data. All right, we're going to use Bloomberg for that. Number three, calculate the multiples. We're going to use Bloomberg for that. Number four, benchmark. Okay, it's basically explain the differences in those multiples and what led to them. And then that's really steps 4 and 5, and that's a lot of the work that you're going to be doing here in this class. Best practices. What are some best practices? Number one, to get past the less comparable, find companies that have similar growth and ROIC prospects. Okay, that tends to make things a little bit more normalized, preferably within the same industry. Number two, use forward-looking multiples, not historical multiples, and forward estimates. Okay, again, you're worth the sum of your future cash flows. Forward multiples are more predictive of the future cash flows than historical multiples. Number three, enterprise value multiples are preferable to PE multiples. Price to earnings, PE, is probably one of the most common multiples used out there. People intuitively have heard of that, price divided by earnings per share. Okay? But the problem is earnings per share is based on net income. So when you explain a PE, which you're going to have to do, you got to explain everything that goes into net income, right? Not just the operating performance. You got to talk about the non-operating performance. You got to talk about the debt and the equity. You got to talk about the one-time items. You got to talk about any accounting adjustments. All of that affects net income. All of that explains PE. So the point is, even though PE is the most simple number out there, it's actually the most complicated one to explain. Right? That's why enterprise value multiples tend to be preferable. Enterprise value to EBIT, enterprise value to EBITDA. Because if nothing else, EBIT and EBITDA stop at EBIT. And you generally explain things EBIT up, which means they're not as impacted by differences in leverage, the financing. They're not as impacted by the difference in one-time items. Okay? So I'm not saying they're perfect, but I'm just saying that they tend to be less distorted. Right, because they're more on the operating value of the firms, right? But they still can be distorted by non-operating items. You got to be careful about that. So, for example, you value Apple. Now you need to worry about Apple selling products. You got this $200 billion worth of cash savings account, okay? And that distorts some of the value of Apple versus another company that doesn't have $200 billion worth of cash selling products. So you got to be also careful even when you use the enterprise value multiples. But nonetheless, we can make adjustments for that, okay? Now, as I said, multiples can be precedent transactions. That's M&A. Just to give you an example of this, in Bloomberg has a precedent transaction database. You may or may not be aware of it. Type in MA. That's mergers and acquisitions. This is a database of 43,731 publicly announced mergers around the world. Okay? So when big companies do mergers and acquisitions, here's where you can get a bunch of data on them. So for example, I'm working in next year with a company called Amgen. So a phone call getting ready for that last night. Amgen, if we look here, type in Amgen, the M&A database, there's every company Amgen has ever acquired publicly. Last year, they bought a company called Horizon Therapeutics for $26.96 billion in cash, right? So if you actually click on it, you'll get data about that deal, right? That deal was announced, summary, December 2022. It closed a few days ago, about last month in October, right? You get some info about the data, but more importantly, you can see the timeline. You can see who the parties to the deal are. You can come down here and see the advisors of the deal. Like, for example, the target was being repped by JP Morgan and Morgan Stanley. Their legal firm was Cooley Godward. Amgen was being repped by Citi and PJT Partners. Their legal firm was Sullivan and Cromwell. Okay. You can see any regulatory and board approvals when they were made, news about the deal, but down here, deal comps. Okay. And the whole point of deal comps, precedent transactions. Those are multiples. And what the same idea was, here are what Bloomberg tried to do, is they tried to find similar biotechs that were acquired. Now, this is over the last 5 or 6 years, as opposed to 2 months, okay? But the whole point is there's some publicly announced deals for biotechs. There's the announcement date, the total value is the price paid, total value to EBITDA, EV to EBITDA multiple. Total value to EBIT, EV to EBIT multiple. Total value to revenue, EV to revenue multiple. Based on biotechs, Horizon Therapeutics, Amgen paid 7.3 times next year's or this year's revenue for Horizon Therapeutics. That based on the purchase price. The average biotech was trading at 35 or sold for 35 times revenue. Okay, so average EV to EBIT was 67. Amgen paid about 40. Okay, but nonetheless, you can look at comparables, and that's the whole point. Horizon's a little less comparable because of the size and stage of where they were with their products, but nonetheless, multiples are a way to evaluate this deal as well. It's called a precedent transaction. All right, but again, one of the problems with precedent transaction, harder when you get to smaller companies. So as I reminded you, I was the CFO for a subsidiary of Blue Shield of California between February 21 and August 22. Right, I ran their Bay Area physician network, which they acquired as an acquisition. I was their CFO through integration. So here's the point. I can't tell you what the purchase price was. Under NDA, not allowed to say it. There's very few people that know that purchase price. It's a closely held secret at Blue Shield of California. But that's the point. Like, there's a lot of companies that get acquired that aren't in this database because the information isn't readily available. And so it's harder to do precedent transactions on smaller and mid-sized firms just because a lot of the data isn't publicly announced. Okay? And they'll announce a deal, but they won't say what's been paid for it because it's not material enough to the size of the company. Blue Shield was a $21 billion company, and the purchase price wasn't high enough to meet a threshold. So they don't want to talk about it. Right? And it's not that they could, they just choose not to, and most companies don't. So that's just the one other challenge with precedent transactions is information availability. All right. One of the advantages is you do work at a bank, you can use the precedent transactions you do have access to estimate potential values in the future. In fact, I was telling previous classes, if you ever get involved in mergers and acquisition, here's M&A math. Remember this beyond this class. It will help you in the real world. It's very simple. 1 plus 1 has to be greater than 2.3. That's M&A math. 1 plus 1 has to be greater than 2.3. Why? Yeah. Because yeah, you need synergies. Has to be more value. And the whole point is the average acquisition deal premium has historically been about 30%. Right? So if you're paying 30% more for something, then when you're together, you have to do 30% better than what they were doing independently. So if you can't get that 30% better, then the acquisition's likely to fail. And the whole point is it's synergies, which means doing better together than you were before. So it's incremental. You get more sales, you get higher price, you get lower cost, some combination. Synergies had to be achieved, but you got to pay for the deal premiums. Problem is a lot of companies don't get those synergies in acquisitions. The average acquisition doesn't do that. That's what academic research shows. And that also messes up the multiples that were paid because you pay for something that you don't get the benefits for. But again, that's a different class. In this class, there are 4 key multiples that are used. Okay, there's more, but these are the 4 most important. PE is the price to earnings ratio. EV is enterprise value to sales or revenue, enterprise value to EBITDA, enterprise value to EBIT. This semester, for simplicity, we're going to focus on three. We're going to skip EV to EBITDA because it's very similar to EV to EBIT, right? And we're going to do PE, EV to sales, and EV to EBIT, okay? And our goal is to do benchmarking and comparables across companies and explain the differences on these multiples. Why are they different? Right? All multiples start with key value drivers. That's what you need to understand. Multiples are based on the key value driver equation. As a reminder, this is the key value driver equation right here. We've been using it all semester. We used it for our continuing value and our DCF models. We used it earlier this semester. We were defining principles of value creation, growing perpetuity, okay? Which basically means if multiples are based on this growing perpetuity says growth spread equals value. Multiples are just expressions of growth and spread. That's all they are. So here's how it works, all right? Key value driver equation. What I'm going to do is I'm going to take some numbers and put it in to that key value driver equation. That is this table, okay? So using that key value driver equation, plugging in 100 million of NOPAT, a 10% WACC, all of those ROICs, 6, 8, 10, 12, 14, and 16, and all of those Gs, 1 through 5, these would be the results of the key value driver equation just displayed in the table. Right? So that's just a table of the results, key value driver equation with those sensitivities. Everybody understand where that data comes from? Questions about that? Why is this column, by the way, stay at 1,000? Why does it stay at 1 billion? Why, despite the growth rate changing, does the value result of this key value driver not change in this column? Anybody have a good answer for that? Yeah.
Like ROIC minus WACC is 0.
Yeah, zero spread. And if your ROIC minus WACC is 0, then it doesn't matter what the growth is, you don't create any value. Why are these numbers getting worse and worse? Why are the values getting lower and lower as the growth increases? Yeah.
Because if you have a negative spread, but that spread is growing, the overall loss increases.
Absolutely. I'm repeating just for the point of the video. If you have a negative spread and you're growing it, the overall loss gets worse and you destroy more value. And the opposite would be true over here. If you grow a positive spread, the more you grow, the faster you create value. Remember those concepts? Those are explanations for multiples. Think about that as we think about the next slide. All right, so here's how multiples work. So I'm going to take this same key value drivers equation, results, top of the slide. I'm going to create the multiples. So with 100 million of NOPAT at a 35% tax rate, that's 154 million of pre-tax EBIT. 100 divided by 0.65. Okay? So here's the point. What's the enterprise value to EBIT multiple? Here, value is 1 billion. EBIT is 154 million. 100 divided by 54, that's a multiple of 6.5. So what we're saying is a zero spread would basically be a 6.5 multiple in this industry. Okay? If I go over here to the 6% column, a 6% ROIC at, for example, 3% growth is only 714 million of value. 714 divided by 154, that would be the same as trading at a 4.6 times multiple. Okay? Same thing. 14% ROIC at 3% growth is 1122. 1122 divided by 154, that would be a 7.3 times multiple. Okay? So multiples are just a representation of those growth spread combinations. But here's the point. If I told you in this industry that there were companies trading at 6 times EBIT, what could we infer from that? If I told you companies were trading at 6 times EBIT, what could we infer, given this data, about companies trading at 6 times EBIT? Yeah.
The industry spread is
That these companies would have a negative spread. Now, can you tell me what their ROIC is likely to be? 6 times EBIT?
less than 10.
We know it's less than 10, but could it be 6?
It could be with a low.
Could it be 7 or 8? See, that's the problem. It could be a range of ROICs and growths that lead to 6. Because, for example, here's a 6, 1 and 6. Somewhere in here is a 6. Okay? So somewhere in this range of ROICs and growth is the right answer, just by looking at the multiple. I don't know exactly where the range is, but what I know is that range is a negative spread. So I know somebody trading at 6 times EBIT in this multiple, in this industry, has a negative spread at low growth. Same thing. If there's a company in this industry that's trading at 8 times EBIT, right? I know they have a positive spread. I don't know exactly how positive, but I know it's positive because there's several answers that get you to an 8 on this chart. Okay, somewhere in here is an 8, somewhere in here is an 8. It's probably 14, 15, 16 at 2 to 3% growth. But that's the point. Multiples are about ranges of answers. It's not about an absolute answer because, one, we're dealing with the future, but nonetheless, it's about what the future could be. So that's the point. It's about proxying out. But I can still get some inferences that somebody trading at 8 times EBIT versus 6 times EBIT, one would have a positive spread, the other probably have a negative spread, and I could infer that. That's multiple analysis, and that's part of what you're about to be doing. Questions? Next. Second multiple is the price to earnings multiple. Here's the point. That's the key value driver equation, just replacing every item with equity. Okay? So we did KVD, we're doing no PAT and free cash flow, ROIC. Okay? But the problem is when you do equity, price to earnings, equity is based on earnings per share. It's based on net income. Okay? So we can basically take the items of net income and equity and put it in the key value driver equation. Therefore, no PAT becomes net income. G becomes growth in net income as opposed to growth in no PAT. ROIC becomes ROE because it's the return on the equity, not the return on the debt in the equity. And the WACC becomes the cost of equity because we discount equity and an equity cost of capital, not a WACC. But here's the point. Same equation, we can get an equity value as opposed to an operating value. Okay? So here's PE. Take 100 million, 100 of net income, at a 10% cost of equity, given these returns in equities from 6 to 16%, and these growth in equity profits 1 to 5% in perpetuity, these are the results of the key value driver formula, or equity values. Take the equity value, divided by the income, you get your PE. So for example, a company with a 10% ROE and a 10% cost of equity would be worth $1 billion. $1 billion divided by 100 million, they would trade at 10 times PE. A company with a 6% ROE and a 3% G would be worth 714. 714 divided by 100, they would trade at a PE of 7.1. Okay? So same concept, but the idea is those key value drivers lead to multiples, but same idea. If people were trading with a PE less than 10 in this industry, they'd likely have a negative spread. If PE was greater than 10, they'd likely have a positive spread. Multiple number 3, EV to EBIT multiple. All multiples are based on the key value driver formula. They have to be, right? So here's the point. We start with the key value driver formula. How do we get EV to EBIT? We rearrange the math. So this is the formula. No PAT is EBIT times 1 minus the tax rate. Enterprise value to EBIT, divide both sides by EBIT. Enterprise value to EBIT, EBIT cancels out. What's left? 1 minus the tax rate times 1 minus the growth over ROIC, WACC minus G. That formula will directly calculate an enterprise value to EBIT multiple. It is the key value driver equation rearranged, but just like McKinsey rearranged the growing perpetuity to break out incremental ROIC, this derivation breaks out tax rate. So tax rate is a driver of multiples. If you have a lower tax rate, you will generate more cash flow and you will be worth more. If you have a higher tax rate, you will pay more taxes, you have less cash flow, you'll be worth less. It is a driver of valuation. Okay? So, multiple enterprise value to revenue. Here's the deal. How do we get to EV to revenue or EV to sales? We start with our key value driver equation. We rearrange it. We basically say NOPAT is revenue times margin. EBIT times 1 minus tax rate over revenue. Divide both sides by revenue. Revenue cancels out, and we're left with margin times all of that. 1 minus the tax rate and all of that is the enterprise value to EBIT formula. So enterprise value to revenue is margin times enterprise value to EBIT. So here's the point. We've been using this formula for 3 weeks because in your DCFs, when you did your as is, I told you to take the enterprise value to revenue divided by the enterprise value to EBIT, and I said that would get you perpetuity margin because I knew this math. It has to, okay? Because if you take this divided by that, you're left with that. That's EBIT margin into perpetuity. Okay, that's what makes the math work. There has to be a relationship between these multiples. They can't be disconnected because it's all based on one price from the company, one set of cash flows for the company, and then we're just rearranging it. Multiples are a simplification of it, but they're still based on DCF. Multiples are an expression of future growth and spread. Now, because it's a simplification, it gets more to ranges of what it can be versus absolute numbers. Easier to get to click down with detail with a DCF than just saying 3 or 4 numbers do the entire value of your company. We are simplifying it, but nonetheless, they still have to come up with similar results, or more specifically, the same results. All right, questions about any of that? Okay, so 2 things. So last Monday, I was teaching at Duke, and I had the executive team for a company called Linda. Sometimes they called it Lindy or Linda. Kept asking, like, how do you pronounce your company name? And they said yes. So it's one of the two, but we'll go with Linda. It's easier to say. Linde, real company. They're one of the largest makers of industrial gas products in the world. They bought a company called Praxair, and they sell industrial gas. Their 2 biggest competitors are a company called Air Products, which is slightly smaller, and this French company called Air Liquide, based in Paris. Those are the 3 biggest industrial gas companies in the world. If you're doing manufacturing, you'll hire them to do your industrial gas. Right? So here's the point. These, using the key value driver formula for multiples, these were their actual price to earnings multiples and enterprise value multiples 1 week ago, last Monday, right? End of day. This was what their PE was trading at the time, okay? And then this is the key value driver equation, okay? So these are the 4 variables. This is the result of the key value driver. Key value divided by income is PE in our model. So the whole point is I tried to match what these 4 variables in our model would equal to explain their current PE for each of the 3 companies based on forward data, okay? So the point of analysis, which you will have to do 2 weeks, week and a half from now, actually November 20th will be your next homework assignment, okay, is I'm going to give you 3 companies. You're going to get and create all this data, and you're going to write a minimum 500-word paper explaining what we're about to do, to explain why is Linda trading at what's called a premium, why is their PE higher than Air Products? Or said a different way, why is Air Products trading at a discount to Linda? Why is their PE lower than Linda? We need to be able to, with this data and these key value drivers, explain that. Somebody just ordered DoorDash?
No, I like hurt my ankle and he was just taking
Oh,
it
that was very
off
nice
his
of him.
life,
Okay.
yeah.
I was like, that's actually new. Students ordering DoorDash in class or Uber Eats. But that's okay. Sorry about your ankle. All right, so here's the point. Let's think about this. Why is Linda, that PE of 24.23, why is it lower than Air Products? Their forward PE at the time was 21.46. Why is it lower? Or why is it higher? Given the data, you got those 4 things, and they understand the key value drivers. So the first part is it the cost of equity? Do they have a difference in risk? They both have a 10%, 10.1% cost of equity. Do they have a difference in spread? Who is the higher spread, Linda or Air Products? Actually, Air Products. Their expected spread at Air Products is 19 minus 10.1. It's 9 points. Linda's expected spread is 18 minus 10.1 is only 8 points. So Linda is actually expected to have a lower spread in the future than Air Products. Well, that shouldn't give you a higher multiple, higher value. So why is Linda trading at a premium? It's the growth. That slightly lower spread is expected to grow at 7.75% a year at Linda. At Air Products, it's only going to grow at 7.2% a year. That's why they're trading at a premium. Right? You can see it. If I change this number to 7.21, their PE would be lower than Air Products. So that's the point. The reason the PE is higher than Air Products is because they have higher expected growth. Why is Air Liquide trading at a higher PE than Air Products? Why is Air Liquide a premium to Air Products? A French company. Who has the higher spread, Air Products or Air Liquide, given this data? Air Products. Okay, so that's the point. Air Products, their spread is about 9 points, 19 minus 10. Air Liquide is about, call it 4 points, 14 minus 9.7. So Air Liquide has a lower spread. Why would they trade at a premium? Well, number one, Air Liquide is growing that positive spread faster, 7.76 versus 7.21. And Air Liquide is perceived to have lower risk, cost of equity at 9.7 versus 10.1. That third element of differences in cost of capital is actually something that people overlook in the real world. Okay? Yes, sir.
Can you explain why it's considered a premium again?
Because premium means higher. This is higher than this. I'm paying a premium. They're more expensive.
So there is, okay.
So when it's higher than something, it's called a premium. When it's lower than something, it's called trading at a discount. So Air Products is on sale compared to Air Liquide.
I thought there was like a base number, you that's you compare it, this compare it.
It's all comparisons. And usually you're comparing one of two ways. You either compare directly to a company, premium or discount, or you compare to an industry average, premium or discount. Okay? For this class, I'm simplifying it to compare to companies, but in the real world, you also might do an industry average and say, how are we doing against an average company in the industry? Does that make sense? All right, so going back on. Here's the point. If Air Liquide had the same risk, their PE would only be 19. So they're benefiting by the lower expected cost of equity. Everybody see that? So Air Liquide has two benefits. One, their growth rate is almost as high as Linda's when compared to Air Products, but they're also growing that lower spread at a lower risk. That's why they're trading at a premium to Air Products. These are the dots I need you guys to connect when you start looking at this data, because just explaining what you see with the numbers and the key value driver equation across companies. Right? Now, last semester, we did an assignment, which was extra credit, called Homework 12. That file is in ELMS in the multiples folder. So I put 2 Excel spreadsheets in files, multiples on ELMS. Okay? One is the solution to Homework 12 last semester, where they had to do Merck, AbbVie, and Lilly, okay, in multiple analysis. And then I also put in a blank template, which we're going to use today to do an in-class assignment that will help you do your next homework assignment, which for you will be Homework 11. Okay? And I can also tell you, for the people here doing extra credit on November 20th, it's going to be a multiples assignment. Okay? But that being said, let's go back. So this was the Homework 12 data already put in, and this is the PE. So the question is, at the time, so think of this as like April 2023, Merck's PE was lower than AbbVie and Lilly. So Merck was trading at a discount, okay? And they had to explain why. Why is Merck's PE lower than AbbVie and Lilly? Well, the first thing you notice about Merck is they have the lowest cost of equity in the industry. So that should be helping them, okay? Because I'm discounting those cash flows at a lower rate. So that's not the reason why the PE is lower. Their cost of equity is 5.9 For example, AbbVie is 7.1, Lilly 7.6. Merck also has the lowest spread in the industry. Even though they have a high ROE of 34% expected against a 6% cost of equity, AbbVie and Lilly are much higher, 106% ROE and 75% ROE respectively. So Merck has the lowest spread. So that probably makes it a little bit lower. But what really hurt Merck at the time is expected growth was negative. They were going to take that spread and actually shrink it over time. Okay? So that was hurting Merck's PE. Why was Lilly a premium for PE? Because even though Lilly had the highest risk at 7.6% and they had the second highest spread, 75 minus 7.6 is a pretty good spread to begin with, they also had the fastest growth. They had the most expected growth in the future of 4.7%. Where AbbVie, if you remember AbbVie, we talked about AbbVie, who had the drug Humira that went off patent. That's why they're not growing. And then same thing with Merck. They have a drug coming off patent. Eventually their big drug Keytruda is going to go off patent, and people are worried about replacing it. That's the negative growth into the future. But the point is, Lilly has a drug which is basically an Ozempic alternative. It's a weight loss drug, which is expected to boom as weight loss drugs boom. So that's all that growth that people expect from Lilly at the time. And so basically that's why they were trading at a premium, because it was high growth at a high spread at similar, even though it has slightly higher risk, similar risk to AbbVie, but much higher risk than Merck. But nonetheless, that was enough, the high growth, high spread, to give them the highest PE. If they actually had Merck's level of risk, their PE would be almost 80. Their stock price would be more than double what it is today. So cost of capital matters. More risk, okay. It's not 80, it's only 30, but that's what that high growth, high spread does. But you still got to address all the factors when you talk about this. Questions? Yes?
I'm guessing to find the G, we're going to have to use gold.
We're going to go through the process to create the numbers next. Right now, I just want you to know, once we create the numbers, how do we explain it? But yes, we will be using goal seeks to figure out G's. All right, final number, EV to EBIT. Here's EV to EBIT. Here's Merck, here's AbbVie, here's Lilly. Okay. Here's what's interesting. When we rearrange the key value driver formula, these were the four parts of it. G, tax rate, ROIC, WACC. Basically growth, spread, and tax rate. Why was Merck trading at a discount to AbbVie? Well, they had the lower growth, negative 1.4% versus 0.6%. Based on operating ROIC, they had a lower spread. Merck, 35% operating ROIC against a 6% WACC, 48% operating ROIC against a 7% WACC. Merck, lower spread. Merck also paid more in taxes, 17.5 to 15.3. Put that together, Merck's trading at a discount to AbbVie. They are benefiting slightly from their WACC, because if their WACC was 6.6%, their multiple would be even lower. So one thing that is offsetting that is the lower WACC, and we'd have to mention that as well. Why is Lilly trading at a premium? Same things. Lilly has the high G of 4.87%. Lilly has second highest spread in the industry with a 44% WACC. 44% operating ROIC against a 7.4% WACC, and Lilly has the lowest tax rate in the industry. These are pretty straightforward. Okay. But they should at least understand why. You should understand why those numbers are higher or lower based on key value drivers. That's the analysis I need you to do and explain. Questions about what you're seeing? All right, here's how we're going to practice in class. I gave you template number 2, which is basically this exact file, blank, 3 companies: Costco, Walmart, Target. Here's how we do it. We're going to do it on Costco, Walmart, and Target. And what I'm going to show you how to do in class today for those 3 companies is how to get the data, what screenshots you will need to submit, and then we're going to analyze it. Okay, that's what we're going to do now. Okay. So let's start out with Costco. We need to go to Bloomberg. We go to Costco first. The first piece of data we're going to need comes from the WACC screen. It's WACC. And this is screenshot number 1. We go to the WAC, we take a screenshot, because you're going to have to submit screenshots to support the data that you put in here, just like you did in your evaluations. No screenshots, no credit for assignments. So screenshot number 1, Costco WAC. 2 data points. WAC at 10.2, cost of equity at 10.4. So I come back to my model. Cost of equity, Costco, right now, 10.4. EV to EBIT tab, WAC, Costco, 10.2. This is 10.21 coming from. Here we go. While I'm on the WAC screen, I'm going to switch this from Costco to Walmart. Take screenshot number 2, Walmart's WAC. I'm going to pull 2 data points off the second screenshot. Right now, Walmart's WAC is 8.2%. Walmart's cost of equity is 8.9. So back to my spreadsheet. Walmart WAC 8.2. Walmart cost of equity 8.9. Third company we're going to look at is Target, TGT US Equity. Take screenshot number 3, Target's WAC. Data point, Target's WAC is 9.7. Target's cost of equity right now is 11.2. Next screen, we're going to go to Bloomberg. We'll go back to Costco. Is EEO. Now again, one of the better practices for multiples, talked about in the book and in the slides a few minutes ago, is we care about forward multiples. And so in this class, we're going to start with the second forward year. Okay? They are more normalized, starting in the forward multiples. Second forward year is the first year of clean forecast. First forward year has actual and forecast data in it. Multiples become more normalized when you do pure forecast years. In Bloomberg, this is last year, forward year 1, 2, 3, 4. Count over. We're going to use this second column, forward year 2. Okay? Net income, second forward year. Costco, and make sure you use annual, not quarterly, $7,542,000,000. Second number off of our fourth screenshot. Take a screenshot of this EEO. Right now, second forward year PE, 1, 2, is 33.16. So their actual PE right now is 33.16. And if I go to the next tab, EV to sales, EV to revenue, just like you did in the DCF. EV to revenue, second forward year is 0.9. And EV to EBIT in the second forward year is 24.79. Last number we're going to get off the EEO is the expected return on equity. If we scroll down on our EEO, here's last year's actual return on equity. Here's the next 4 years of forecast. Now, ideally, that return on equity should be the perpetuity return on equity, just like a continuing value return on equity, all right? I got the next 4 years. I'm trying to think about what perpetuity would look like. So for Costco, last year's ROE was 27.5%. This year, 25, then 23, 21, 22. Okay, it seems pretty stable in the low 20s. So I'm just saying, I think in perpetuity, low 20s might be a reasonable return on equity for Costco. They're not a roller coaster jumping all over. Now, ideally, I do an as-is valuation. I do a DCF. And that probably gives me a better understanding of the perpetuity values. But as an approximation, if I use 21 or 22%, I think I'm probably reasonable. So I'm going to use 21.5. Okay. Next, we're going to do the same thing for Walmart. So I'm going to switch this to WMT, US Equity. I'm taking screenshot number 5, Walmart CEO. All right, second forward year net income, 19,091 as of today. They're a bigger company than Costco. Walmart's PE, second forward year today, 23. Walmart's EV to revenue, 0.75 in the second forward year, right now. Walmart's EV to ebit, second forward year, 17.35. I can already see that they're trading at a discount to Costco, which is one of the things we're going to be explaining in just a minute. All right. Final number I'm going to get off of the EEO is Walmart's expected return on equity. Looking at their next 4 years, last year they were 15, 21, 21, 21, 21. Okay? I keep repeating 21 for some reason, so I'm going to use 21. I think that's reasonable for Walmart. Finally, we're going to go to Target. Take screenshot number 6, Target's EEO. Their net income in the out year, second forward year, 4,069. Their PE for the second forward year is 12.34. Their EV to revenue of the second forward year is their 64 cents per dollar. And their EV to EBIT is 11.97. So pausing, if you have an EV to sales or EV to revenue of 0.64, what that means, if these multiples repeat themselves, is when Target sells $1, they add 64 cents to their value. When Costco sells $1, they add 90 cents to their value. So Costco is creating more value when they sell things than Target. Okay? When Target generates $1 of EBIT, they're adding about $12 of value, 11.97. When Costco generates $1 of EBIT, they're generating almost $25 of value, 24.79. That's the interpretation of the multiples, by the way. Going backwards, final thing we need is we need an expected ROE for Target. If I looked at the next 4 years, based on screenshot number 6, 23, 28, 29, 31, 32, I might give them credit for like 31. Somewhere 30, 31, 29 even, but much higher than Costco and Walmart is the expected ROE of Target. Okay? So, as you can probably guess, we're going to use GoalSeek to solve for the G's. But before we do, we got to finish the enterprise value to EBIT. We need tax rates and we need ROICs. So let's start with tax rate. Tax rate is guidance, GUID. That's where we start, just like in our DCF models. So for Costco, we go to GUID and see if they have any tax rate guidance. And thank you, Costco, for giving us tax rate guidance of 26%. Screenshot number 7. Close this template out. Let's go to Walmart, see if they give us any guidance. Take screenshot number 8 if they do. Thank you, Walmart, 26.5%. And then let's go to Target's guidance for screenshot, hopefully number 9, for their tax rate guidance. And damn, they don't seem to have any tax rate guidance. So if you can't find tax rate guidance, where do we go? We said we're going to use JP Morgan's analyst report as a proxy. So we go to BRC. We go to the JP Morgan report, which was this one. We actually did this earlier. Went to the first JP Morgan report released on the page. It didn't have the tax rate in it. Went to the second JP Morgan report from August 21st. It did have the tax rate in it. So that's the one I'm actually using. Tax rate. For tax rate. And the out years they're using 22. All right. Finally, we need the operating ROICs of the three companies. All right. So I'm going to go back to Costco. I can also do this with Target. And then I'm going to go to RV. So I'll stay at Target, do RV. And we have a custom formula for operating ROIC. If for some reason you can't calculate your operating ROIC, use the regular ROIC. Okay? But here's the point. Right now, the operating ROICs for these companies are in these columns. Those ROEs that we're using for perpetuity, which is what we just put in, look a lot like today. Today looks a lot like tomorrow for these companies. So the market's not expecting a lot of changes. So in this case, I can probably use today's ROICs in perpetuity because I'm using that to represent what tomorrow looks like. So in this case, Target 9.3, 9.34. Take a screenshot of this if you're using it. 9.34 for Target. For Walmart, 9.61. And for Costco, operating ROIC 26.46. Soon I'll be solving for my G's, but I have to notice some things about my data. First of all, the only thing we don't have growth. Without growth, these are the EV to EBITs. So what I'm going to have to do for Target is solve for a growth rate that turns an 8 into a 12. So I know the growth is going to be positive because I know Target's still growing as a company. But here's the problem. What happens when I grow this negative spread? I'm not going to turn 8 into a 12. If I put any growth rate in here, the multiple is going to get worse. So I know that this is not the perpetuity ROIC. It's not 9%. I also know that there has to be a relationship between the ROIC and the ROE. So if you have a 31% ROE, you don't likely have a 9% ROIC. Something's amiss here, okay? Because just think about this. If I oversimplify, because I'm ignoring taxes for purposes of this example, but if I did drawing, where's drawing on here? Draw. Price or a profit, it's supposed to be a P, divided by investment, profit divided by equity. Times. If profit over invested capital, which is approximately debt plus equity, it's not exactly 1-to-1 because we're doing operating, but if I multiply by debt plus equity, over equity, basically your leverage ratio, I get return on equity. So profit over debt plus equity times debt plus equity over equity equals profit over equity. So that's the point. Like, what explains the difference between ROIC and ROE? It's how leveraged you are. So it's just the ratio of the leverage. So here's the point. If I know target's ROE is 30% and I know their leverage, I can approximately figure out their ROIC. So I can work backwards as a method number 2. Because method number 1 doesn't seem to work reasonably. So given a 31% ROE, what likely do they have? Well, I did a WAC screenshot. And on the WAC of target is about 76% equity and 23% debt, 23.5% debt. So 24% debt. So here's the point. They're leveraged about 3 to 1. Okay? So what I'm going to do, given that leverage ratio, is I'm going to multiply just as a proxy here. But I'm going to basically say for target, their expected return on equity is about 75% of their return on equity. It doesn't like the fact that I was using that drawing thing. Okay. Equals return on equity times about 75%. So somewhere around 23-ish ROIC is what would be required with that level of leverage to get to a 31% return on equity. Right? I'm going to say the same thing for Walmart. If we think that Walmart's return on equity is going to average 21% in the future, and Walmart's leverage from our previous screenshot, they're about 87% equity, 13% debt. So what I'm going to do is I'm just going to take equals 0.85 to proxy times the 21. I think Walmart's going to be closer to about an 18% ROIC. There should be some relationship between ROIC and ROE based on leverage. Okay? So I'm just saying, number 1, the relationship's either there, but if we're not in perpetuity, the perpetuity numbers don't match, we got to somehow sync them up. If we think we got a reasonable ROIC, you can infer an ROE. If you have a reasonable ROE, you can infer an ROIC, but they have to sync up. And in this case, they probably sync up for Costco, but I don't think they sync up for in perpetuity right now, Walmart and Target, so we just did. Final step, by the way, does everybody understand what I just did, how I did it, why I did it, and when I did it? All right, final step, we solve for a G. Okay, this is where we use the goal seek. So for Costco, the PEG, tools, goal seek, set the PE, which is B9, to the current PE, which is 33.16, by changing the G. We're going to goal seek Walmart. Set their PE to be 23 by changing a G. And then we're going to goal seek Target. To 12.34. And I'm going to goal seek the G's for the other multiples. Tools, goal seek the EV to EBIT for Costco to the 24.79 observed value. Changing B5. I'm going to goal seek Walmart's G, operating G. The B11 to 17.35. And then I'm going to goal seek Target's G. Now, on a side note, the G's that we just did on this tab should be very similar to the G's in our as-is DCF. Because think about this. If we're doing ROIC as a proxy for cash flow, and we did ROIC as the key driver of our as-is model, those G's should be the same. Okay? So this is another way, by the way, which we're not going to do, it's more advanced, but to actually test your as-is. Okay? Because you can do a multiple analysis on, for example, NVIDIA, and you can actually see what kind of G we get out of the multiples, and we can see how close that is to the G we do in our DCF, because they shouldn't be that different. They should be the same. Okay? That's triangulation. We do the multiples versus the valuation. But for Monday, I'm not asking you to do that. Right? But you could if you want to play around with it. Now let's go back and explain. Now that we got the data, does everybody understand where all the data is coming from, how we got it, the screenshots required to submit about getting the data? The process? Yes. Go ahead.
Where do you find the tax rate for target?
So either GUID guidance, if the company gives it to you, use the company's guidance. If the company doesn't give it to you, as I said, we're going to the sell-side analysts, and we're going to say, what are the sell-side analysts using? Because they had to also forecast a tax rate. JP Morgan usually does. We're using JP Morgan's analyst report. That same process as we did for our as-is valuation. What was your second question?
Could you explain why you multiply, or recalculate for the ROIC for the Walmart or Target?
You're talking about that scribble on the right?
Yeah.
So bad scribble because I'm having trouble with this mouse trackpad and drawing. But the idea is return on invested capital is, I'm proxying, is like profit over debt plus equity. It's kind of like the simplified version of invested capital. Again, assuming non-operating assets don't exist. Okay? And return on equity is profit over equity. This is what I was trying to do with my scribble. Okay? Now I'm ignoring taxes with the number on the left, and I have taxes the number on the right, but I'm making a couple simplifications here. But the whole point is, how do I get from ROIC to ROE? I had to multiply by leverage. So if I just did some algebra here, if I multiplied by debt plus, it's a D, plus equity, so my trackpad is having trouble writing, divided by equity, these cancel out, and I get the PE. So the difference between the number on the left, ROIC, and the number on the right, ROE, is your leverage ratio. So if I kind of know the leverage, I know how to connect the two, just approximately. Okay, because that's the point. That's what I just did. So I looked at the WACC and I looked at the leverages. I just worked backwards from the ROEs to approximate an ROIC. Right? So back to explanation. Now we got to explain premiums or discount. Why is Costco trading at a premium to Walmart? This is pretty clear. All right? Costco has a similar, though slightly worse spread than Walmart. 21.5 ROE against a 10.4 cost of equity. Walmart, 21% ROE against an 8.9% cost of equity. Basically a 12-point spread at Walmart, but an 11-point spread at Costco. Costco's got a lower spread. But Costco's expected to grow that spread at about 8.59% per year. Walmart's only growing that slightly higher spread, 5.74% a year. That's what Costco's trading at premium. All right. Now, Walmart is benefiting by their lower cost of equity. Okay? Because if Walmart had, sorry, put it this way, go the other way. If Costco had an 8.9% cost of equity, their PE would be almost 200. Stock price would be 6 times higher than it is today. Right? But they don't because they take on more risk than Walmart. And so their PE is only 33. So they're benefiting by that high growth at slightly lower spread, but they're being headwind, offset a little bit by the higher risk. We got to say that higher risk because risk does play into this. People often skip that last part. Why is Target trading at a discount to both of them? Why is Costco trading at a premium to Target? Costco has almost double the growth of Target, 8.6 versus 4.2. Costco has a lower spread than Target. 31 minus 11 is a lot higher than 21.5 minus 10.4. So Target, their spread is almost 20 points. Costco is only 11 points. But they got half the growth of that spread. And Target has, so when you put all of those together, don't know what just happened there, then you end up with a lower PE. Okay? Questions? That. All right. The next thing that you have to explain is the enterprise value to EBIT multiple. Costco, 24.79, Walmart, 17.35. It's very similar. The only difference is now tax rate plays into this. Well, the tax rate at Costco and tax rate at Walmart are almost identical. Slightly higher at Walmart, 26.5 versus 26, but probably not enough to be too meaningful. But that does hurt Walmart's EV to EBIT, right? But I'm just saying, if we made this 26, it's not going to change things that much. Okay? So what's really driving it here is Walmart has lower spread. 17.85 minus 8.2 is less than the 26.46 minus 10.2. And Walmart's growth rate of 5.2 versus 8% at Costco. So really, it's Walmart, much lower growth at slightly lower spread for similar taxes, are why Walmart's trading at a discount. But Walmart is being benefited by that lower hurdle rate. Because if Walmart had the same risk as Costco, their PE would be 10. So what's helping Walmart in the EV to EBIT, sorry, EV to EBIT would be 10, is the lower WACC. That's benefiting them. But really, it's the lower growth at lower spread that's causing them to trade at a discount. Why is Target trading at a discount? Well, they have the lowest growth in the industry at 4.4%. They also have, from an ROIC perspective, slightly lower ROIC than Costco. But as I said, half the growth, and even though it's slightly lower risk, that lower growth of 4.4 versus 8.13 is why they're trading at 12 times EBIT, and Costco's trading at 25 EBIT. It's very straightforward why these multiples are what they are. Okay? The final multiple that you have to explain is EV to sales, also known as EV to revenue. Here's the point you need to understand. The bias is EV to revenue is based on margin. If I sell things at a higher margin, people should pay more for my sales. Here's what's interesting. Costco's operating margin is 3.6%. Walmart's operating margin is 4.3%. Walmart makes more than Costco when they sell something. Yet I pay more 90 cents for Costco when they sell something. I only pay 75 cents for Walmart when they sell something. So that's the opposite of the bias. So something else must be at work here. And the something else is productivity. Walmart spends 18 cents per dollar to generate sales. Costco spends 10 cents per dollar to generate sales. So Costco's putting in half reinvestment of Walmart, and therefore they're generating a higher ROIC, 26.5% versus Walmart's 18%, and that's why Costco's sales are more valuable. The reason why Target, which has the highest margins, has the lowest EV to sales is because their productivity is also high and their ROIC is lower than Costco, and that's why people pay less for their sales. The reason why they pay more for Walmart's EV to sales than Target's EV to sales is because Walmart has a lower WACC. Because remember, I'm also discounting these cash flows. So even though they both have a similar amount of expected productivity, half of what Costco's is, Walmart's lower WACC gives you a higher EV to sales than Target. Never forget about WACC affecting these. Those would be the three multiples that you'd have to explain. That's how you'd have to create the data. That's how you'd have to basically give screenshots to support the data. That's the assignment due in a week and a half. All right? If you want, you can put this aside, focus on your group projects for Monday, and we'll have the Wednesday after that to talk more about this before the next homework assignment's due. TAs have office hours tomorrow and Friday. I've recorded this video. It will be online. Good luck. Look forward to hearing your presentations next week. Where is the sign-in sheet? If you didn't sign the sign-in sheet, please sign it before you leave today.